Okay, we're, I think, maybe a few seconds early, but welcome to a special Sunday night edition of the Anderson Report. I am Tim the Source Anderson. This is my YouTube channel and my Periscope channel, TV channel, if you're watching on Periscope. And we are going to talk about where we are with the markets exactly at the halfway point of Q3. So today is August 16th. We ended the week on August 14th. That's two weeks into August. Volumes were definitely starting to lighten up a little bit. Bear with me just one second. Volumes were definitely starting to lighten up a little bit in the market last week. And we saw on both Thursday and Friday a couple of the lighter volume days we've had this summer. And also the S&P 500 and the Dow Jones running into significant resistance and just not having enough oomph to get through those resistance levels and catapult to the next level. Now, that being said, nobody's going to argue with the performance of the S&P 500 being up 50% from its lows in late March, which we of course call the Ackman lows, and the Dow Jones close to 50%. Maybe the Dow traded with an 18,000 handle. It's now trying to get through the 28,000 level. I mean, that's just an astronomical move. And as a colleague of mine highlighted in his research note, I believe it was on Thursday night, and it got a very nice mention in Barron's over the weekend, that this was the strongest 100-day rally for the S&P 500 in history. Some people said since 1933. That was also obviously coming off a very, very low point in the market. I don't think the S&P 500 was really a thing in the 1930s. So that reference might have been to the Dow, the Dow Jones Industrials, which of course has many different components. Of the Dow Jones 30 Industrials, I'll bet there aren't more than 3 or 4. There might not even be that are in the Dow Jones Industrials today that were in the Dow in 1933. So even though that was a very strong rally off the depths of the Great Depression in modern times, this is the strongest, and we mentioned it a little bit last week, 100-day rally that the markets have seen, with a number of other stats added onto it. It's very typical that after you get a very, very, very strong rally for 3 or 4 months, that, if you look out 6 months later, 8 out of 10 times the market is higher. Now, look, no markets are exactly alike. There's certainly no guarantee that we'll be higher 6 months from now. There'll be a lot of things that will. We have the unprecedented situation of coming out of the virus, with the hope that there will be a vaccine and or a successful treatment program. And of course, we have the election in a little bit less than 3 months. So let's take a look at where markets are exactly halfway through the quarter, and talk a little bit about what we think needs to happen if markets are to continue the bullish mode that they're in, given that they could pull back, 3 to 5% at any given point in time. What we'd like to avoid is a 12 to 15% pullback. So, as I mentioned, the Dow has hit 28,000 intraday for a couple of days, pulls back from there. doesn't get through it, but it's still right there. It's less than 100 points from 28,000. Went out at 27,930. The Dow is up 8.2% quarter to date, but it's still down 2.1% year to date. Clearly, big declines in Boeing, some of the financials, the energy names, Exxon and Chevron, and a few of the big banks. We'll talk about energy and financials are very interesting. We'll talk about them in a little bit. So the Dow up a little over 8% quarter to date. The S&P 500 a little bit better than that. The S&P 500, the old closing high from February 19th is 33.86. We'll just say and change. It's a little bit less than 33.86 and a half. Okay. So the S&P scratched that on Thursday for more than just a minute or two. Scratched it on Friday for barely just a couple of 5 minutes. Backed off 33.72 spot 85. Quarter to date up 8.8%, up exactly half of that year to date, 4.4%. So look, that's, resistance right now for the S&P. Volumes are light. We could close above it, but I think to close above it convincingly and then use that level as support or a base. A lot of times when you get through a technical level that's been difficult on the way up, resistance levels become support levels. For that to happen with the S&P, I almost feel like we need a little bit of a new catalyst for the market to make a new move higher, given that it's 50% off its March lows. Okay, so the Nasdaq, obviously the big story this year, the internet traffic trade, the 6 to 8 to 12, maybe even more mega cap, mega growth stocks in the tech sector that have been driving the internet traffic trade, that are huge beneficiaries from working at home, staying at home, playing at home. The Nasdaq basically flat on the week. Look, it's had a monstrous move this year in this quarter. It's up 9.5% quarter to date. Halfway through the quarter, it's up 23% year to date. Just over 11,000. 11,019. The closing high for the Nasdaq is just above 11,100 from August 6th. So the transports, we've started talking about the transports quite a bit in the last week. They've had a huge move this month and quarter to date. They settled last week at 10,960, just below 10,960 by a few decimals. They are up 19.5% year to date. So Dow Jones transports, railroad stocks, airline stocks, some shipment, maybe a couple container stocks, UPS, delivery stocks, but mainly railroads, airlines, shipment stocks, and just clearly the airlines got pummeled in the crisis. Volumes were astronomically low, trying to come back a little bit. For the airlines, last week's TSA numbers were just a little bit better than what they had been the prior week. We will get numbers for both Fridays. I think we'll get updates they don't update on the weekend. So we will get TSA traffic numbers for the airlines for Friday, Saturday, and Sunday at 9 o'clock tomorrow morning. I will probably put them out on Twitter. Okay. Now, The transports up 19.5% quarter to date, settling just below 11,000. But because they got beat up so badly when the crisis became a thing and when the virus became a thing, they just went in to positive territory year to date last week. They're up 0.5% year to date. The Russell 2000 had a very nice week. We've mentioned that there's some reallocation. I've heard it from numerous highly regarded uh, fund managers for more than one money management complex. There's some asset allocation going on into the small cap stocks based on the fact that the economy, one way or another, is going to recover, and the small cap stocks had wildly underperformed and were mercilessly beaten up on the way down. I think they were down as much as 41% at one point. The Russell 2000 went out at 1577.88. It did hit that 1600 level a couple of times. That's the next resistance going forward. The Russell is up 9.5% quarter to date. It's still down 5.5% year to date. Now, technically, we mentioned that the Dow has some resistance at 28,000. The Nasdaq has some resistance at its that the S&P 500 definitely has resistance at its old high, 3386 and change. Yeah, the Nasdaq 11,000, it closed above it on August 6th. That's the high, just over 11,100. It really only closed above it then again on Friday. Maybe one other day this week, flat on the week. I think this 11,000 level, it's gonna be maybe a tough level for maybe another week for the Nasdaq. And look, I mean, the transports have had just a monster move. They'd had a lot of resistance really at 10,000, and once it got through, went to 11,000 in a hurry. So, but there are some very positive things going on technically with all these big market averages, and that has to do with what they call either the bullish cross or the golden cross of the 50-day moving average going up at a sharper angle, increasing and going up through the 200-day moving average. When that happens on the way up, it's called a golden cross and is thought to be a bullish signal. It worked out well for the S&P 500. It made that cross on July 9th, and the S&P has rallied for the last 5 weeks. It made that cross on the Dow Jones average August 6th, and the Dow had a pretty nice week last week. It's making that cross for the transports and for the Russell 2000 literally right now. Like it's either right there and you're going to see it Monday or Tuesday. It's got so much momentum, there's no way it won't happen. You're going to see it go through the 200-day, and you're going to see it on the Russell 2000 also. We'll see if that helps both those two averages that have had pretty sharp moves quarter to date. Really, really just incredible for the transports. We'll see if that helps give them some support, something to watch. One other thing that jumped out at me a little bit last week, the markets around the globe actually had very good weeks. A very good week last week. The Nikkei 225, that's the Japanese market, was up 4.3%. Now, the Nikkei settled at about 23,300, a little bit below that, a little bit below 23,300. And the level to watch, if that were to continue to rally, it would probably take at least another 2 or 3 weeks, is the 24,000 level. Just for your other market historians, that's clearly nowhere near the all-time high for the Nikkei. The all-time high was about 38,000 back in in 1989. Um, and then the Nikkei had the whole Japanese economy and markets had what they called the two lost decades of zero interest rates uh, and zero growth. So uh, we're going to watch the Nikkei a lot the rest of the month and certain probably even going into September. But I'd also add the European markets acted well. And I don't want to lose the paper that I just had. The European markets acted well last week. And it wasn't because of the euro being weak. The euro was actually strong compared to the dollar. But the FTSE was up over 2.5%. That's the UK market. The German DAX was up 1.8% on the week. And the French CAC 40 was up 1.5% on the week. Now, those might not sound like big numbers, but they had very sharp declines very early in the week. They gave some of that back late in the week. So I think it'll be interesting to see, very telling to see how they act going into next week. The feeling from a lot of people that have been really studying the virus a lot is that the Eurozone came out of its virus peak, or maybe its second little bump, excuse me. So, excuse me. So, if they came out of that, if the Eurozone came out of its virus peak and has been trending lower for virus stats for the last 2 to 3 weeks, their peak in the virus was 2 to 3 weeks before we peaked, before it got really bad here. And there is some data going around from last week and a little bit from the very tail end of the previous week that hospitalizations are down. People in ICU units significantly lower. And virus counts, although they might still be going up in a few hot spot areas of the Sun Belt. Geographically, I've mentioned them all so many times, you don't want to hear them again. That people feel that we're beginning, we're on the beginning of the downslope of the worst of this last big virus outbreak. And of course, we've been testing millions and millions and tens of millions of people. So we've got a lot of positive tests, but we're now getting positive tests for people that say that I don't have any symptoms and I really feel fine. So, not really sure what that means. There's different versions of the test out there. I don't think they're all necessarily false positive, but it's possible that some people could have the virus and not be having nearly as adverse a reaction to it as a lot of other people are. Now, where does that bring us? Something to watch going forward. We're halfway through the quarter. We had decent employment numbers last week with the first-time jobless claims below 1 million, continuing claims falling to 15 million from its peak. We also had decent retail sales numbers on Friday, misreported by a lot of people, and when they report retail sales, as they do a number of other economic data points, they give you a headline number, which is everything, and then they give you a number X autos. Because autos are big ticket items, and there's some seasonality effects to auto sales, that there's times during the year when they get very strong, and there's times when they're not that strong. So on the headline number, we came in at 1.2%, up 1.2% from the prior month. On the X auto sales, we came up plus 1.9% on the prior month. Now, that's not nearly as strong as we were in June. These were July numbers. So up plus 1.2 on the headline percent on the headline number, up plus 1.9% on the ex autos number. That's certainly not nearly as strong of an increase over what we had in June, but June's numbers were bumped higher to right around plus 7.5 to plus 8.2% over May. So there's two things to consider here. The plus 1.2% or plus 1.9% retail sales for July over June is over the number that was revised higher, not the previously reported number. So it's over an even higher number than what we thought June was, because retail sales are sequential. When they say it's up 1.9%, that's month over month. That's over the prior month. That's not over the month from a year ago. But the one other very positive data point on the retail sales number for July was that retail sales were 2.7% higher than they were in July of 2019. That's well before. That's when you had a, a normal economy, a normal summer, normal things going on. Nobody had ever heard of the virus didn't exist yet. And we were cruising along at 3.5% unemployment, you know, very, very low weekly jobless claims numbers, strong income growth, average hourly earnings well above 3%, increasing well above 3% on an annualized basis for the last 18 months. And our retail sales for July 2020, definitely impacted by the virus, were 2.7% higher than retail sales July 2020. That just tells you, look, we've still got a lot of work to do, but that tells you how strong the American economy is, even with the still 12 million fewer people employed than were employed a year ago, et cetera, et cetera, et cetera. So I think so the market's had this big V-shaped recovery, okay? The Nasdaq up 23% year to date, well above where it was in February. The S&P 500 right where it was in February, trying to make a new high. The Dow 2% below that level. The economy has had like maybe a little bit more than half, between half and 3/4 of that right arm of the V. Fairly sharp, fairly good recovery. Big bump in May, big bump in June, off admittedly very, very, very weak numbers. Now, a little bit of an increase in July. We had a decent jobs report. We also had an industrial production number on Friday that showed industrial production was up 3% in July from the previous month. Again, a number that there's still more work to do, but those numbers are going up. People are concerned about August because the extra $600 unemployment kicker that the Fed was adding in stopped at the end of July. But maybe that's why we had a sharper fall off in first-time weekly jobless claims than people had expected. So the question is, what do we have to do to get the economy to the next level? And I think there's really like three or four key things. You've got to find a cure for the virus. Now, there are some cures out there, but there's not a vaccine. There's allegedly 3 or 4 vaccines in stage 3 trials. There were these comments early last week that Russia claimed they had a vaccine. I don't think any of our medical professionals really gave that a grain of salt. basically what Russia did was like what our pharmaceutical industry would do, and our FDA would do a stage one trial. So, stage one trial basically says if you get through it, okay, there's no ultra bad side effects. Okay. Um, but you've got to find some type of a cure for the virus and or some universal treatment that people are comfortable with, that or a vaccine or a combination of everything, so that people feel comfortable going back to some approximation of their normal life. That will help open the schools. It will help get businesses back to higher capacity, and it will help us get back to having big public events and indoor activities, bars, restaurants, sporting events, where people are, where we not even say that we can do it, but people are comfortable attending and or participating. Because if you don't have that confidence among society or the consumer, let's call it, if you don't have that confidence level, you can say, okay, open the schools, okay, open the businesses, okay, restaurants and everything can, reopen at 50 or 75% capacity. If people aren't confident, then it's not really going to matter. So you got to find some answers for the virus. You've got to kickstart the economy into second gear, or maybe third gear. Maybe we're kind of already in second gear, depending on how many gears your transmission has. That's almost hand in glove with getting an answer for the virus. And you need to instill that confidence among people that they can go to restaurants, they can go to indoor activities, they can send their kids to school, they can go back to work, they can take mass transit to work, they can get on an airplane and go take a vacation, they can go to a vacation spot where there's going to be a lot of other people, they can go, do the things that they used to do and not feel like they're, one breath or one point of contact from getting a virus that's going to be very bad for them. And then the fourth thing, which is a little bit tangential, but and half of it's easy, half of it's very tricky. You still need this two-pronged stimulus. You still need this two-pronged monetary and fiscal stimulus to get people through the very, very challenging economic times that a lot of people are in. Now, when we say monetary stimulus, we say the Fed. That's the Fed. Okay. The Fed has been very clear that they're not even thinking about maybe raising rates, or they're not even thinking about ending their bond purchasing programs. Okay. So that part of it is going to be status quo for quite a while. I would say at least into the middle of 2021, maybe even late 2021 or the beginning of 2022. There's going to be very, very low interest rates. Maybe what if they move them up 25 or 50 basis points a year from now? Still, they're going to be very, very, very low. And then you need some type of a deal. It's going to be very difficult to do because it's very political with the election 80 days away. You need some type of a fiscal stimulus plan to get through Congress. And when we say fiscal stimulus, we basically mean tax policy and or other policies that will affect people's net take-home income, spending, et cetera, et cetera, et cetera. Whether they make, Trump signed these executive orders 2 weeks ago. Actually, I think it was probably 8 days ago. Of $400 extra unemployment kicker down from $600, but he wants 100 of that 400 to be paid by the states. A lot of states have said they can't afford it. The Democrats want him to rescind the 10% cap on a total of on the aggregate of real estate tax and state income tax that is allowed for deductions. It used to be unlimited, and now it's capped from the tax bill 3 years ago. It's capped at 10%, $10,000. So you can only deduct up to $10,000 on a combination real estate taxes or property taxes and state income taxes. Okay, so big, a lot of states in the Northeast have high, they have very high real estate taxes, and they also have high state income taxes. They're hurting from that. They want him to take it away. I seriously doubt that he's going to. They also want a lot of money for a lot of their favorite projects. They're now on recess until early September. It's either just before or just after Labor Day. Labor Day is a little late this year, I believe, because the first Monday I don't think is till the 6th. So they might be on recess until the second week in September. We'll see we'll see it'll all depend on how much the Democrats want to give on that. Will all depend on what their internal polls are telling them on the issue when they come back from break. So look, that's kind of where we are. We're halfway through the third quarter. The market's performance has been phenomenal. The economy's performance has been better than expected, but some people are concerned it might be stalling a little bit. Some people think the extra unemployment insurance kicker is going to make a huge dent in GDP and in consumer spending. Some people feel it's going to get a lot more people to go back to work a lot faster than if it was still there. So it's a little bit of a double-edged sword. But, we'll take a real quick look at what the best performers were last week. We've been talking about quarter to date numbers, and I think it's meaningful because we're halfway through the quarter. Exactly. And I would say the Dow up 8%, the S&P up 9%, Nasdaq up 9.5%. Certainly the transport's up 19.5%. Russell up 9.5% quarter to date. Those are quarter to date numbers. We're halfway through the third quarter. So we're 6 weeks into the quarter. We got another 6 weeks to go. Those numbers are not going to be doubled. We're not going to have that amount of growth that we've had over the first half of the quarter is not going to be able to replicate itself in those averages during the second half of the quarter. We just would like to avoid a 10 to 15% pullback. If we get a 3 to 5% pullback, I think that's okay. And look, there were a lot of comments over the weekend in the financial press and from some of the really smart people on the internet. There's a little bit of a concern about valuation and I think that's out of whack because they say we're at 26 times this year's earnings, but everybody knows that the second quarter earnings for this year are, absolutely a mess because of the virus and the economic shutdown. And the market's giving that a one-off. The market's looking forward. The market's looking for earnings next year and in 21. And then there's people that'll say, look, even over the next 4 quarters expectations, we're trading at 21 times the market, and that's a little rich. That's higher than, much higher than the historical 15 or 16 times. But historically, we haven't had rates at zero, and we haven't had the Fed adding huge amounts of liquidity to the system. So I think that those two things are two of the key reasons why um, you've got the market trading at a 21 PE, and a lot of people aren't that bothered by it. Some people are, don't get me wrong. But I think that the fact that the third thing would be we had a very, very, very strong economy coming into this, and people feel that's still there, especially when they see a retail sales number come out, and retail sales for July 2020 was almost 3% higher than it was for July 2019. But there are some other metrics just in the, let's say, the sentiment side that some people feel we're either a little bit too bullish, or there's a very low number of people that are bearish, or we're a little bit too complacent as to what where the market would go if we had a real hiccup, more than just a hiccup in the economy. We've got very low put call ratios, right, over the last couple weeks, and we've got very low number of bearishness or bears in different sentiment readings that come out on bearish bullish sentiment. So it's just something to be aware of and be tuned into a little bit. I don't know that I would act on it in large scale right now. But we can certainly look at a couple of other key items from last week. I mentioned the Nikkei had a very good week. The European markets had a good week. The Dow Jones Transportation Average up 3.6%. Sure, of course, it's up 19% quarter to date. Now, here's the best acting sectors of the S&P 500. The industrials were up 3.1%. Second, energy was up 2.3%. Consumer discretionary up 1.5%. Obviously, that's consumer discretionary is very different than consumer staples. Consumer staples is the stuff that you have to buy regardless, toilet paper, food, supplies, basic supplies for the house, etc., etc., etc. Discretionary is stuff that you want, not just stuff that you need. Materials up 1.5%. We've talked about materials a lot. They had a decent week last week. Let's see if they can continue that. And financials up 1.3%. So let's talk about energy and financials. Energy has been very volatile. It'll be up 3% one day. It'll be down 1.5% the next day. And the next day it'll be up 1%. The next day it'll be down 1.5%. But on the week, with everything shaken out, and I think crude holding 41, holding 41 and a half. Let's see if crude can hold $42 this week. Certainly no guarantees of it. All you need is a headline out of the Middle East for it to trade down, 3 to 5%. But energy up 2.3% on the week with that's the energy sector, with some pretty volatile moves in between. And financials. Look, these are not the financials from 20 years ago that can have just like, monstrous. They haven't been in a leadership. It used to be, it was very, very hard for the market to have a sustained bull market move without the financials at least participating, if not leading. I just can't imagine a scenario right now where they would really lead if rates are going now. Yes, the yield curve is steep. It's actually quite nicely steep, but every data point on it's a very low level. So although it's steep, it's upward sloping. I'm not going to say it's steep, but it's consistently upward sloping all the way through the curve, which is positive. You certainly don't want it to be downward sloping. That's helped the financials a little bit. I think watching energy and watching financials as we go through the rest of the summer and into September, I think those are two key sectors. I mentioned the small caps. The Russells had a big move this quarter, but they were all up net last week. S&P 500, S&P mid cap 400, Russell 2000, all up between 5.5 and 6%. So, on the downside, real estate, utilities. Utilities had a nice move, hit resistance, couldn't get through it. Gold down 3.6%. Gold obviously has had a monster move. I you know, I don't. I just have the feeling the the rally in gold is not over yet. Uh, and silver down 5%. Silver's ridiculous. It moves 5%. 4 or 5% almost every day. Net. So it probably had 3 days down and 1 day up, 2 days up. It was down 5% net on the week. Anyway, um, look, we're going to get some housing numbers this coming week. We'll, of course, get more weekly claims on Thursday. But we're going to have some really important housing numbers coming up on Tuesday and probably also on Wednesday. We're going to get an Empire manufacturing report tomorrow morning. These regional Fed reports sometimes get a little volatile, but that'll be that report will get some attention. There's no doubt about it. And given the move that the home builders have had and everything related to home buying, home furnishing, home remodeling, even you want to talk Lowe's and throw in Lowe's and Home Depot and all the building supply stocks. The home builders have had a big move. They could continue that. You've got rates, 30-year mortgage rates below 3%. So, but these housing numbers are going to get a lot of attention. So, look, it's Sunday night. I certainly hope everyone had a nice weekend. And this is the Anderson Report. We will be talking to you again tomorrow. If you have not subscribed yet, please hit the subscribe banner on my YouTube page, which is The Anderson Report. Hit the little bell next to it if you want notifications on when the next broadcast will be. I am Tim the Source Anderson. My Periscope TV is TJ Anderson 12, and my Twitter handle is TJ Anderson 1. Everyone have a great week, and we will talk to you tomorrow evening. Take care.